Hey, if you're a multifamily investor, you already know insurance costs is one of the biggest line items you're going to deal with this year. But what if you had more control over that cost? See, today we sit down with Nicolas Lares, who is the founder of InsurTech, and they help investors just like you and I take more control over their insurance costs and turn it from a cost center to a profit driver. That's right. If you want to learn more about how to flip the coin on insurance and turn it into a profit driver as opposed to a cost center, check out today's conversation right here on Multifamily Insights. Before founding InsurTech, Nicolas Lares is one of the largest brokers for Amazon's logistics network. Now, when rising insurance costs and carrier exits threatened to shut down his clients, he helped them create an alternative, a platform that allowed delivery providers to pool together and form their own insurance group, giving them control over insurance pricing and their profits, not to mention long-term sustainability. Now, today, InsurTech applies that same model to real estate. As a syndicated insurance group, it enables property owners, operators, and investors to retain the profits traditional insurers keep, averaging $28 million in annual distributions per $100,000 units insured every year. Let's welcome to the show, Nicolas Lares.
Yeah, thanks, John. Appreciate you having me. That was a fantastic intro. Couldn't have said it better myself.
Well, I didn't write it. I mean, so I can't take I can't take credit. I just read it. But no, listen, great background, man. You guys, you clearly have done something incredible and found an opportunity in the marketplace and have helped other people navigate this landscape. You know, for those who aren't familiar with you and your story, why don't you take 2 minutes and give us a little bit more context?
Yeah, yeah. So I mean, yeah, based off of the introduction, insurance isn't something that people are born one day and say I want to be an insurance agent when I grow up. So there's a running joke in the industry where, hey, if you end up in insurance, it's either because you're a third family, right, generation insurance family, or you kind of just stumbled into it by accident and then decided to stay once you realized how awesome it was. And I'm in the latter bucket. I was introduced to insurance through my best friend growing up. He was part of a third generation insurance family. And we were graduating right when kind of COVID was starting to roll out across the US. So graduating college, thinking I'm great. I'm gonna go into IT. I'm gonna do right, cybersecurity sales, make a ton of money selling tech. And March 2020 hits, and I was essentially the first one that was let go of a new IT firm that I was just hired at. So I was pretty much back on the job market when the entire world was shut down. And really, the only thing that was out there moving around was Amazon delivering packages to people's homes during COVID. So my buddy, third generation family, they tend to work with a lot of new and emerging risks and markets where if an insurance company kind of wants to test out a new space, they rely on these deeply embedded networks of broker partners who they say, hey, here's a product, here's a market we want to go after, kind of distribute it to the market for us, let us know how it goes. And then after, 5 years of collecting some data, some loss history, then carriers will typically reevaluate if they want to stay in the space and continue, or essentially back out and say, hey, it was great to try it out, but this isn't for us. So, right, we were newly built insurance agency going after Amazon and their last mile delivery vans that were driving across the country from 2020 to 2025. And it was a great market. We were one of three brokers who were insuring everything with an Amazon logo on it and wheels. And things were going well, built up a book of business of hundreds of clients across the US, and things were great. But then come to find out the market was very difficult, right? Anybody who is involved in personal injury law firms or personal injury attorneys, they essentially found out, hey, we can follow these vans as they're driving and delivering. And if they run into somebody or get into an accident, we can jump out, hand the person a business card and say, hey, we're going to help you retire because Mr. Bezos is going to end up paying out a nice package for you because his car hit your vehicle. Well, lo and behold, these companies were third-party logistics providers. They were not Amazon. It wasn't Jeff Bezos who was actually running the show. So my clients essentially were impacted by a lot of real fraud and litigation that started entering the market where carriers hate that. They can't predict it. And it turned into a market where they ultimately decided and said, hey, we're going to back out. We're making money, but we're not making enough where we think it's worth it to exist in the space. So from one day to the next, I'm telling hundreds of my clients, hey, I might not be able to offer you an insurance policy next year. You might have to shut down and fire 100 of your drivers, your employees, and it was great doing business with you while we had it up and running. So, in order to prevent that from happening, we essentially had to go out and find an alternative to the traditional insurance market, something most brokers really never have to do in their entire insurance career. So, it was really a necessity, right, that created this where we said, all right, we've got hundreds of millions of premium that we're collecting from our clients every year. Let's try and go and find a way where we can essentially backstop them with a reinsurance company, make them their own collective insurance group, if you will. They had the volume to be able to do it. And once we built out that model, our job was pretty much done, right? We technically didn't have to sell insurance anymore. We built an insurance group for the industry itself. Once that was rolling, my job was like, great, this is awesome. I can't believe no one's ever done this before. But now where do I go and deliver this model? So after that, right, 2025 decided to pivot into real estate and say, hey, right, we're going to follow markets where carriers are backing out because that was the same exact signal, right, in the Amazon market that we decided to follow. So once carriers in Florida, carriers in California started saying, hey guys, we don't want to insure you anymore, that was essentially a signal to me and say, hey, this is a perfect industry where we're going to jump in the space. We're going to essentially help people self-insure, retain their own profits in the mix, and give them more of a stable solution where they can be part owner, right, of an insurance company that insures other owner operators, other real estate investors, everybody who's exactly existing in that same niche or market, and make them the insurance company at the end of the day. And that's essentially how InsurTech was born.
Nicholas, I love it, man. You talked about one, just if you get into insurance, it's either because it's third generation or you just fell into it and you fell into it and your buddy was third generation. So there you go, tag team combo. But you
Exactly.
also talked about Amazon, right? And that Amazon kind of logistics network and running into those challenges where a lot of the carriers said, hey, you know what? This just isn't worth it because yes, we're making money, but folks are suing you guys left and right, thinking that they're going to hit the payday with Bezos and not realizing that that's not really, their company based on the infrastructure. So the insurance companies back out. You recognize there's an opportunity to step in because it was large enough. You were able to create this network where they could be self-insured, and now you're identifying those kind of opportunities in the marketplace, particularly in real estate. Let's talk about the real estate landscape because insurance has been the thing that has, more investors groaning than anything else I can think of outside of interest rates, particularly over the last 3 to 5 years. And you mentioned California. I know Florida and Texas have seen insurance costs, double, triple, quadruple, carriers just backing out completely. Talk to us about the landscape of insurance. Why are we seeing these premiums jump up? Why are we seeing insurance carriers drop out of multifamily in particular, but real estate as a whole?
Yeah. So I think the root problem of what's going on in the insurance marketplace, it's really a psychology issue between how policyholders view the value that an insurance product or an insurance company gives them for the amount of money they're paying them every year. Right. So let's walk through an example. Before COVID, insurance was a line item, like you said, wasn't really that big of a deal, wasn't really a headache for people. Yes, it was an expense that kind of people didn't like to pay for, but it was a necessary evil. And the cost was low enough where you were fine just paying it every year and not really thinking about it. But once COVID hit, right, 2020, prices started to skyrocket. Now insurance is enough of an expense where it's really a thorn in people's side, where when they pay an insurance company, right, that premium every year, they're now thinking to themselves, well, hey, what if I would have just kept this money in a bank account every year instead of paying an insurance company? That would have been a better situation for me. Or, hey, now that I've been paying all this money for all of these years, I need to see a return on this product. I need to see some value. Like insurance is one of those products where you pay a company all this money with hopes to never actually use it. So I think the psychology over the last few years has began to change where people have been looking at insurance and thinking, where can I get an ROI from this spend? Because it could be the difference, right, between me squeaking out an NOI or not at the end of the year. So I think people over the years have begun to, when a storm comes by and the roof starts to leak 10 years ago, I'm just going to patch it up. I'm going to pay it out of pocket. I'm not even going to waste my time getting involved with the insurance company. But now, when a storm comes by and your roof starts to leak, you start to think to yourself, man, I've been paying an insurance company tens of thousands of dollars every year. I'm going to put them to work and file a claim to essentially have them come in and either replace my roof or something where I feel like I'm getting value out of this product. And I think that's been the biggest difference of what's changed 10 years ago for now, where it's leading into kind of a cascading network or a negative feedback loop where carriers are increasing rates because people are filing more claims, and people are filing more claims because carriers keep increasing rates. So it's really a really tough position where we have to change the incentive model, where how can we figure out to make sure people still get a form of value from their insurance company without having to file a claim. The only way to do that is to, right, redistribute any profits that are left over at the end of the year, because you're getting a return whether you file a claim or not. You feel like you're getting value for the price and the cost of what your insurance expense is worth.
Yeah, you talked about that negative feedback loop. Folks are not seeing the value in their insurance because the premiums have gone up. So now they feel like, hey, I've been paying this for years and I've never filed a claim. The next time there's a big event, I'm going to file a claim and absolutely get something out of this, right? And because
Exactly.
of that, you're seeing this loop where more claims are being filed. Their now premium increases, and because these premiums are increasing, people feel like they need to file claims to justify these premiums. And this is a cycle that we've seen. Can you contextualize like maybe the increase in claims that we've seen over more recent years?
Yeah, I mean, it just goes back down to the psychology of it. It really looks like, imagine a train heading off a cliff that is getting faster and faster every year, because the more insurance rates go up, the more people feel like they're getting robbed. They feel like they're subsidizing a system where they're getting penalized for being good at the insurance game. It's insurance is a game of odds, right? It's a game of probability. So it's a lot like going to a casino playing blackjack. It would be like, imagine playing blackjack, you get 21, and the dealer says, "Great job. I'm going to take your money. You lost. You got lucky. You didn't have to file a claim. Something happened. You were fortunate. You didn't need to use your insurance policy. Great. You lose." Where the people who, right, maybe get a 12 and the dealer gets a 21, and they get a pile of cash for losing the game. And it just really messes with people, I think, internally, to look at a system where, wait, I'm paying all this money. I don't file claims. I'm a good risk in an insurance company's eyes. But the people who file claims, the people who are not running a tight ship, who don't invest in repair and maintaining their properties, they're the ones that are getting return off of this product that I'm essentially subsidizing. It just feels very unfair to people, and that's something that people now are looking at an alternative, because they're realizing this. They're looking at their neighbor who just got a brand new roof when their home was built at the same year, but there's nothing wrong with their roof. And they're saying, "Hey, why are you right? That impacts my insurance rate." Because now an insurance company comes in and says, "Well, this property just got a brand new roof rebuilt. Maybe it just needed a patch. So we're taking maybe a $4 or $5,000 cost, and it's being inflated into $50,000 cost. And that impacts everybody's rates in that zip code moving forward." So it's really just a tough situation where people are looking at all these issues going around them and thinking, how do I remove myself from the system where I feel like it's rigged? I feel like the odds are stacked against me. And how do I get an alternative that works for me in a win-win scenario?
Yep. Yeah. So we know that this is definitely becoming an issue and a pain point for a lot of investors. You've talked about kind of one of the solutions that you and your team kind of put together here, which is really allowing them to benefit on the upside. Talk to us more about how that actually works.
Yeah. So, the formal structure of what we're doing at InsurTech is essentially placing our customers in what's called captive insurance programs. Captives have been around for decades. They essentially were built for Fortune 500 companies in, right, big industrial complexes, logistics companies, even hospitals. Instead of paying an insurance company millions of dollars a year, they essentially set up a captive, which, think of it as like a bank account that they have control of, that is backed by a reinsurance program on the back end. Right? Some captives don't have reinsurance, some captives do, but essentially it's a bank account that they control, that they still pay, right, their insurance premium to. But at the end of the day, since they own and control the bank account that they're dishing all that money aside every year, since they own it, if they don't need to use it, it still belongs to them, and it comes back to them even after they file claims or need to pull funds out of that bank account for a typical insurance claim if it were to occur. So what we're doing is taking that exact model, and instead of isolating it to an independent company with $1 million balance sheet, we're essentially creating grouped cell captives where your premium that you spend, yes, you get an insurance policy, but you also get a pro rata stake in the asset itself that's insuring your property, your building, your residence. So we're taking, right, a value proposition where it's, hey, give your money to an insurance company and you'll never see it back. Or you can put your money with a captive insurance company. It operates, it looks exactly like a federal insurance company on paper, but at the end of the day, you're essentially building equity in that asset. You're a co-owner of the insurance company. So at the end of the day, if it generates profits, it goes back to you. There's no third party shareholder where if we collect more money than we pay out in claims, we're going to go to our shareholders and say, hey, look, guys, we just generated a bunch of money for you. This was awesome. Our customers are our shareholders. So if we generate money, we're going back to our customers and saying, hey, guys, you overpaid. We're going to give this back to you. Let's go ahead and look at next year, and we get people on that track. We're just aligning those incentives across the entire insurance structure.
Yeah, and I think it's, man, it's fascinating. A lot of things to consider. Let's back up just a little bit, right? So first of all, you talked about it really being almost like a bank account where you're paying into this with your premiums, but you're getting a slice of ownership. If you guys turn a profit, then you get some of those proceeds, right? But then there's reinsurance programs where they're kind of really coming in and fulfilling any claims that are made. Let's go all the way back, right? Because maybe folks don't understand how insurance actually works. We get, I pay premiums. If I file a claim, I get a check. Unless I'll use State Farm just to use one of the big ones. I pay my State Farm premium. If I file a claim, State Farm, covers the damage, right? Is that State Farm's money? Are they like how does all that work? Like, does State Farm just have a big huge bank account and they say we collected X amount of dollars in premiums, so this is how much money we have to pay out? Or is there something else going on in the back end with those guys?
Yeah. So we'll break down, right, insurance. Um, Essentially, insurance is a product that is a forward looking or a projected cost, right? So it's not a physical product where somebody can manufacture it for one price and then they sell it, right, with margin in between to the general market. When an insurance company gives you a policy and quotes out your premium for the year, they don't know what their return on that policy is going to look like. They know what it looks like over millions of policies that are pooled together because they can predict that out over a year. But for you, they don't know what your policy is going to actually cost them. So what they do is a carrier will give you their costs. They'll add a broker commission, 10 to 15%, because they distribute it to you. They'll add in some additional profit margin based off of how many claims they think you'll file. And then they'll add a little bit on top just to be safe. So in the event that you end up filing more, it's not coming out of their pocket or they're not having to tap into reinsurance on the back end. So if you look at an insurance product as a bunch of all these different, right, margin pieces that are built in, but none of them are actually a true fixed cost. It's a projection. So when you pay State Farm $10,000 a year to insure your property, there are fixed costs on that. It's maybe $30,000, right? That pays for their employees, that pays for the office, that pays for Patrick Mahomes and Jake from State Farm to be on everybody's TV on Sunday night watching, right, football during season. That's 30% of the costs. And your broker who you bought it from is getting 10 to 15%. And then from there, the remaining, right, 55% essentially is just what they expect your claims will be and a little bit extra for margin just to be safe. So if we could take that same model and say, hey, if we can carve out any unnecessary expenses, right? Yes, we can work with brokers if they want to work with us and distribute our product to their client base. We can cut them out of the picture. That extra profit margin, since that's a future projection, what if we could just hold on to that and say, hey, if the overall pool performs better than what State Farm predicted it would, that's essentially profit margin that we think should go back to people at the end of every year versus State Farm. That trickles down to profit to their balance sheet and their bottom line. So, I tell people when they look at insurance, they think, oh, well, if we did good that year, State Farm should just lower their rates next year. And my answer is yes, they should, and they do. but they're still building in their margin. They're still batting in their future expected costs. So if you keep performing well, yes, the carrier is going to lower your rates over time, but they're still squeaking out margin that is more than what their fixed costs plus the claims are to essentially administer your policy. And that's kind of like what we're breaking apart. We're bringing transparency to people to realize that, yes, just because your insurance company doesn't tell you what their fixed costs are, doesn't mean you can't question it and think, hey, is there any way where I can retain some of this margin? Because it's at a point where it's really breaking into your NOI and being too much of an expense where people feel like they're forced to really start asking these questions and looking at alternatives, which is why they're really starting to pop up across the real estate insurance market.
Nicholas, how much leverage do we have? I mean, we can obviously get those policies, we can shop around and get different quotes and try to get some different premiums, but how much leverage do we have to negotiate and maybe get better terms on our insurance policies?
Yeah, unfortunately, people want to think that just because they haven't filed a claim in in 2 decades, that they should be getting the best price comparative to everybody else that's out there on the market. And I agree with them, right? I think they should, but the only issue in that scenario is insurance is pooled risk, right? Your policy premium is not based off of what a carrier thinks you will pay; it's based off of what a carrier thinks the entire market, who everybody who shares your same business model, your same asset type, it's what they will pay, essentially what you're paying for. So, what people are realizing by essentially joining captive structures, they start thinking like an owner. So, when you're in an insurance company that you're an owner of, when you see a storm come around next year and you can file a claim for just $5,000 or handle it out of pocket, your incentive as an owner is to make your asset profitable, right? So, we're essentially realigning the incentives where now the pooled risk that you're a part of thinks better. They think like an owner. They want to take right control of their costs. They really want to dive down and invest in risk management and produce a return for this asset that they now co-own, right? Where if you're looped in with the bucket with somebody who has no agency, they have no incentive to not do things better when a storm comes, to try and do everything that they can to solve it out of pocket or solve it on their own. So we're changing the incentives by giving people that carrot, that ownership stake in it, where we're putting people who are in the same boat and who want to row in the same direction, right? We need to get people away from the bad risks, the people who are filing fraudulent claims because they just feel like they need to get a return out of this somehow along their investing career. So we're going to start pulling people out of the traditional market who want to see a profitable insurance company, who want to see a profitable return, who want to drive down claim activity, even if they already being very right, they're not filing claims at all. Great, I should be in that bucket. I should get some form of a return for not being a bad risk, right? They want to be in the position where if they're at the blackjack table and they get 21, they want to see a return and see their money compound. They don't want to lose that money for being good. So we're kind of pulling people away from that model, right? Where they're starting to see those signs where they're like, okay, my premium is not based off of my own independent activity. It's based off of everybody's activity who is in the same business as me. I want to align myself with people who are going to do a good job, not subsidize the traditional market where I'm pooled in with people who are not doing a good job. They don't invest in repair and maintenance. They're not maintaining their properties well. And those are the people who end up filing claims at the end of the year, right? So we're taking people out of a broken system and putting them into one that not only works for them, but they're incentivized to work for themselves. It's really just a better alternative across the board.
What's the criteria for moving in this direction? Like, is there certain qualifications? Like, how does one decide or know that, yep, this is right for me?
Yeah. So first of all, we don't right. We take any type of real estate model that's out there, whether commercial, residential, single family, multifamily, self storage, you name it. As long as there's a building that's up and there is some form of a lease agreement in place, right? So you don't own it yourself and you're not living in it yourself. We can essentially help insure the property itself. When it comes to like insuring tenants and residents, that's the beauty of being in a captive. You can offer more than just your own insurance costs. You can actually offer insurance policies to anybody who's involved in your asset. We can also help insure them as well. So for the resident piece, we typically like to say, hey, we want to see units that are typically 50 doors or more, or something where we want whoever enters into the captive in the program to be a net surplus driver of profit for everybody else. We tend to find where, hey, if it's less than 50 units, right? One claim, kitchen fire, $100,000, and you're a net drag and reducing the profitability for everybody else who's in the captive program with you. So we want to find people, right? It doesn't mean if you have less than 50 units, you can't join. You can go and find partners or other right people in your market or your area and say, hey guys, I've got 10 units, you've got 20, you've got another 20. We can pool people together and essentially say, hey, as long as the sum or the total amount of your group is going to be a net surplus on the resident piece, we can group people together. We just want to make sure it's going to be profitable. So a lot of times I typically tell people don't think it's a no off the bat. Think that it's a yes, right? Reach out to me. Let's have a conversation. Let's look at your portfolio because there are some scenarios where maybe, hey, if you have right 30 units, but they're all class A luxury, where residents might want to opt in for a $300,000 limit policy instead of a 100K limit policy, which the pricing on that is 2 to 3x. So we can potentially still bring you in where you can be generating a profit for the overall captive. And let's figure that out on a conversation. Don't just count yourself out before even reaching out.
Yeah, it sounds like there's multiple layers, right? You're talking about on the resident side, the property itself, you can cover pretty much any property. But if you're bringing in individual residents, then more renters insurance. It sounds like now you're playing more of a numbers game, but lots of information there. What's the best way for folks to learn about this? Right, it's just come to your website, which is insuretech.com. Insuretech is with the number three, so INSUR, the number three, TECH. But how else can folks wrap their head around this? Because this is a fairly complex idea or concept
Yeah.
for people if you've never heard of this.
Yeah, it's definitely a lot of educating. So I'm posting a lot on LinkedIn. I think that's a really easy way for people to kind of learn about it. Just look me up, Nicolas Nicolas, Lares Lares on LinkedIn. I typically post on there daily, just giving insights, case studies, overall insurance dynamics of how the industry works. So if you want to kind of learn more about it, read more through some actual right verbiage of how it works behind the scenes. You can, if you're a
Yeah.
reader, that's a spot where I'd recommend you go. But really, the website has a lot of information and just helping people understand that, you know, viewing insurance differently is, I think, really just the dynamic. Or once you start thinking like an insurance company owner versus just an insurance company customer, I think just asking yourself those internal questions will really help you understand where the nuance is in sticking with the traditional model versus going the self-insured or the co-owned route, where it's just like right being a resident who rents your home versus somebody who owns your home. Just looking at going in and acquiring your first property will really help you understand the nuances of the industry itself, where you don't have to go out and try and acquire an insurance company. You just have to think along the lines of, how do I put myself in a position to own the insurance, not just be a paying customer? And just kind of asking yourself that question. Most people have a good understanding of markets and business models. And frankly, insurance really aligns a lot with like the financial market. So it's very similar to a mortgage company, if you will, where there's typically a backstop, right, called the Federal Reserve, that kind of releases interest rates. So it puts supply of funds into the market. And then banks come in, aggregate loans together, put mortgages in place, and they make their spread in the middle. The insurance model works very, very similar. Are essentially what we're doing is cutting out the bank and saying, hey, we're going to go place you straight to the backstop. So that way there, the margin that was in the middle between beforehand, that enters into your balance sheet instead of a big bank who's lending you the money instead. So very easy concept to really understand.
Is there any, major risk or um, exposure that we haven't mentioned? Like, is there, uh, I don't know, we just ask that.
Yeah. So the good thing about our model, it's almost like a build to bear workshop, if you will, for insurance products, right? So we have larger enterprise accounts that've got 10,000 units or more. We essentially can come to the table with them and say, hey guys, you have enough volume for every insurance dollar that you spend where you can be your own insurance company by yourself, stand alone, right? Have your own bank account. And you might not need reinsurance because you're that large where if a building were to fall down, 2 years of paying insurance premiums and you can rebuild the whole thing from scratch. So there are different structures that we can place people with where you can elect to take on more risk, right? Without reinsurance, you're reducing your monthly essential fees by about 20 to 30%. So if you want to come to us and say, hey, I want to retain every single dollar that I spend on insurance, I want it to go to my own claims, and I want all of those dollars to come back to me at the end of the year that's not used for a claim. we can set you up in that structure. If you want to be in a model where you say, hey, I don't want to be in a position where if my bank account runs out of funds, I have to come out of pocket to redo the difference, right? We can place you in a model where there is reinsurance that's backing you, where your monthly expense is going to be 20 to 30% higher than without reinsurance, but you're protecting yourself from the downside. So we give people essentially the freedom and the customizability to kind of pick and choose which model they want to be in, depending on their portfolio size, what their market rate looks like, and as well as what their internal claims activity looks like. So if you're somebody who consistently for 20 years, you haven't filed a claim at all, and you're 5,000 units or more, we can look at putting you in an independent cell without having to reinsure it, right? As long as you're aware of the risks, you know what, right? If the downside comes where you run out of money at the end of the year, you might have to fund the difference. Some people are okay with that. But really taking a look at both sides, right? If you can look at the property level and the resident or the tenant level. For example, we just sent out a quote for a multifamily property in Georgia, 80-unit apartment complex with an office building on it. The total cost to insure that property was about $14,000 a year, right? At the property level itself, we're on average returning about 20 cents of every dollar back to our customers. So his net costs to insure the property is really about $11,500 every year, right? But we took a look at his resident piece, 80 residents. If they also paid their own insurance costs, maybe some deposit insurance instead of posting a deposit, we can generate a profit from his residents about $20,000 a year just by having them pay the same insurance company that he pays, right, with his own insurance premium, which, he happens to be a co-owner in, right? So he, on a net basis, is having his own property insurance costs paid for out of pocket because his residents are generating enough of a return to where he, on a net basis, is no longer having to pay $14,000 out of pocket and is generating a surplus of about $9,000 a year because his out-of-pocket insurance costs are 11.5, but his residents are generating $20,000 in profit for him every year. So that's kind of like the power, what is capable of a business model like this, where you can start owning and retaining insurance profits. It can really change somebody's bottom line, where if it compounds over a 5-10 year period, that apartment owner is going to have a very different portfolio in 10 years from now if he can just retain a net surplus of insurance dollars every year than what he's been doing of paying $14,000, $15,000 out of pocket every year.
Yeah. Nicolas, love it, man. Great example. I appreciate you bringing that example home for all of us. If you want to learn more, check out Nicolas on LinkedIn. He's pretty active. And also go to the website, insurtech.com. We'll link to both of those in the show notes. Nicolas, right now we're going to transition and go to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmancapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Give me a failure or an apparent failure that sets you up for later success.
Man. Well, that's a hard question because I don't like to view failures as failures. I like to view them as just learning opportunities to kind of advance from better. But I don't think there was a certain failure that really hit me hard to the point where I was like, all right, I got to do things differently. I think it was just transitioning my mindset over time. I played baseball growing up, so I was in a sport where if you failed, you were still technically winning. So I think being in that position where if I failed 7 times out of 10, I was still technically doing really good. I think building that mindset from a young age where, hey, just because I'm failing doesn't mean my outcome is a failure. Maybe I can just tweak the process a little bit. I can just get better, or I can just view it differently where, hey, just because I'm not on paper, it says I'm failing, but I'm really getting further along to like my long-term goal of being a better baseball player or getting through difficulty and just learning how to deal with failures as they come and turn them into wins. I think the biggest thing for me, maybe to answer that question, was just changing the mindset of looking at failure differently. It wasn't one failure that really set me up for success. It was really just changing the mindset of how I approach failure that I think has led me more to the success I'm seeing versus just one specific event that happened to me over time. Does that make sense?
Yep. Give me a digital or mobile resource you recommend for our listeners.
I don't want to sound too much of a parent, but I think if people are not using AI yet in any form of capacity, I'm a big Claude fan. Started it off just testing out ChatGPT in the early days and just seeing what was possible. And I think if you're not using some form of AI, even if it's just to kind of help you formalize your thoughts or just kind of act as like an adversarial debate against your own logic and thinking, it really helps you formulate, I think, better internal frameworks, better model, where if you don't know how to implement AI in your business, at least try and help it where it can improve your own thinking personally. So, right, if you're having a problem that you're facing or you've got an issue that you're trying to tackle and solve, but you don't really know how to start, I think learning how to use AI to really fix your own problems or fix your own frame of thinking internally, I think is a great thing that everybody should be interacting with, at least on a minimum, internally.
Give me the book you've recommended or gifted the most in the last year.
Yeah, that's a good one. I've got two. The one I've gifted the most of, this book called Love Does by Bob Goff. It's really, I think it's just like a big mindset. Again, I'm a big mindset guy. So I think the Love Does book really helps people just approach things. If you can approach things from just a state of happiness, a state of love, and try and put yourself in a position where no matter what, if it's good or bad, I'm going to love whoever it is that I'm talking with or doing business with. I'm going to just approach it from a mindset of, hey, this is going to be great no matter what. I think that was something that really opened up my eyes a lot because, again, right, you're in business, you want to see the right outcomes, you want to succeed, but a lot of times people will burn their bridges just because of how they show up at the table. They come off as being really rude, or, hey, we lost and it's because of your fault, and right, anger and fear and all these other emotions kind of get in the way. But if you can kind of just switch those over and say, hey, that's all right, we failed, but hey, I loved working with you. This was a great opportunity. The next time that person comes around and thinks of a good investment opportunity or good deal, they might reach out to you instead of somebody who treated them poorly, from that same bucket, right? If the roles were reversed. So that's one I've really shared a lot and helped people get in front of. One I typically recommend, I like the 7 Habits of Highly Effective People. That's one of my favorite books, really just to try and figure out how do I maintain my day-to-day and set myself up where I can build good habits to, right? You are your habits at the end of the day. So that one and Atomic Habits, I think, are really 2 good ones that I typically recommend people who really need help kind of organizing internally to then create better outcomes externally. Those are 2 good ones I would recommend for people to read if they haven't yet.
Love Does, 7 Habits of Highly Effective People, and Atomic Habit, 3 really, really good books here. All right, give me a daily habit that helps you stay focused on your goals.
Working out's a really big one. In the morning, I think having a good morning routine set, I think starting off your day on the right foot really compounds into the rest of your day. So me personally, my morning routine is I like to try and wake up with the sun as often as I can. So for me right now in Chicago, that's around 6:30 a.m. when we start to see the sunrise trickle through. Personally, I'm a man of faith. So the first thing I like to do as soon as I wake up is just kind of get in the Word and read my Bible a little bit. It kind of sets me off on the right path where, obviously, right, depending on your religion or what you believe in, the Bible is a story about being able to let your faith lead you through any obstacle or tough position that you may find yourself in. So I think as a business owner, it's a good mindset to kind of start off in that position. And I like to lead my faith and let God work through me a lot. And starting off my mornings by reading the Bible is a good way to do that. And then I'll go in and I'll work out immediately after, just do some type of cardio, HIIT training, anything to really get the blood flowing through the system. I think if anybody can do those 2 things, whenever I do those 2 things in the morning, my days are dramatically different from the days when I don't do those things in the morning. So I've been really trying to be on a strict habit structure of building those 2 things in my morning routine every day.
Give me your number one insight for, let's say, being more efficient with our insurance costs.
Uh, I mean, not to plug my own business here, but reach out to InsurTech. Really, that's your only way. Or if you have somebody who you trust, a broker who you've got a good relationship with, have them reach out to us. We're moving really fast in the space, and insurance companies, as everybody knows, are very slow to innovate. They're very slow to adopt new change. So, I mean, we think we can be an alternative that will exist for probably another 5, 10 years before the rest of the market really comes around and maybe tries to offer the same type of structure. So, the only thing really is just to find a way to get involved in a captive as soon as possible. The sooner you can start retaining your own insurance costs and let it compound over years, right? The 10-year difference on that can look like your business being double the size of what it is versus it not. So I think just trying to find a way to get off the traditional insurance path, whether it's through InsurTech or asking your broker to reach out to find a captive structure that you can be a part of. Um, Whatever way people can get into captives, whether it's through us or someone else, I think the better for the industry as a whole. And that's something that's part of what I think my mission is as a whole, just to teach people about captives, whether you come through it through us, through InsurTech, or somebody else, and you end up in a captive. I just think it's a better alternative altogether for the industry. So my goal is just to see every property, every building, every type of real estate owner or operator just be involved in some type of captive structure, any capacity you can. And the sooner the better. You'll thank me for that.
All right, Nicholas, you are based in Chicago, one of my favorite cities. Give me your favorite place to grab a bite to eat.
Man, it changes. I will say it changes. I'm a big hog salt fan. So if Bavette's, Au Cheval, Guilt Bar, Chichio Mio, those are some of the best restaurants I'd find in the city. But I will say they are impossible to get a reservation the past year. So unless you wake up at 8 a.m. on a Saturday morning to book a reservation for 3 weeks out, you're probably not going to get one or eat there. Um, I do like, you know, Italian. I'm Italian and Argentinian, so I'm in a perfect city to have good meat and good Italian food. A really good, awesome environment that's not that hard to get a reservation. It's a little hard, but just a beautiful restaurant, amazing food. They're actually a Tuscany approved restaurant because they get all of their ingredients from Italy. Their recipe and their process of cooking food is exactly how people make it in Italy. So Tre Dita is, I think, one of the first like Tuscany approved kitchens and restaurants in Chicago, where if you haven't tried that out, it's in the St. Regis, right off the river. So it's a beautiful restaurant, amazing food. They hand make their pasta, and it's usually if I'm trying to do a special occasion or take somebody else to a nice dinner who's never been to Chicago before, Tre Dita is going to be my first pick to go to.
Sounds like an amazing choice. Even those of us who have been in Chicago many, many times and lived there, it sounds like a great place to go check it out for the first time. Great stuff, Nicholas, man. You talked about really insurance and understanding insurance and why our premiums keep going up. And to get out of that cycle, that endless negative loop, you really have to change the dynamic, right? And changing that dynamic means taking more control, getting into these captive programs where now some of the proceeds or the profits you make are coming back to you. And if you can really reimagine that game, now you're in the driver's seat. You're putting yourself in a position to get some great value. You're not playing the same insurance game everyone else is playing. And this is something you want to learn about and see how this can be another tool in the tool belt to help you grow and scale your multifamily portfolio. Again, if you want to learn more, check out insurtech.com. We'll put a link to that in the show notes. And make sure you follow Nicholas and check out some of the information he's got to share there on LinkedIn. Thanks again for being a great guest and coming on the show today. We look forward to staying in touch with you, and I hope you have a great day.
Yeah, thanks, John. Appreciate having me on. Hopefully, I could have been a good resource in educating your listeners on a different path for insurance moving forward. So I appreciate you having me on.